U.S. stocks, they took their cues from Europe's troubled debt market on Tuesday, staging a comeback rally to end up more than 1% in closing bell. Economically sensitive sectors that had sold off recently were the strongest performers, suggesting investors saw value in beaten down shares. For the day, the Dow gained about 163 points, the S&P 500 index was up about 15 points, and the Nasdaq Composite as well added a good 33 points in trade.
Look at Asian markets and look at other basic risk indicators. So look at Asia. Asian markets are trading a bit mixed. Hong Kong is down by about 31 points, followed by Japan, which is flat. Singapore is a small market. It may not nudge the needle much for our markets. Kospi is down, and China is trading flat with a downward bias, a cut of about 2 points. But the currency markets and bond yields, they to my mind are really telling us the story. The dollar index is now way below 83. Euro has stabilized against the dollar at about 1.25, and if you check on global volatility on your screen, CBOE VIX, that has taken a knock of about 6%. So needless to say, global markets which were crying for something positive about a week ago, where risk had occupied center stage, now things have changed, and things have changed at least in the near term in favor of the bulls. So technically things are looking stable. Technically, there is a hope that regulatory action will bail us out, be it US Fed, Reserve Bank of India, Chinese Central Bank, or ECB. So there is a flavor of risk on. The flavor of risk on has come back not because the fundamental picture has changed, but the technical outlook has changed, courtesy hopes that central bank, they will print money that will drive asset prices, and that really explains that why fund managers who were hiding in US Treasuries, who were hiding in US dollars, they are suddenly revisiting risk. Douglas Blake joins us, Senior Wealth Manager with Newbridge Securities, joins us live from New York. Douglas, always a delight to have you back on ET Now. Thank you for joining us. Douglas, fluctuating fortunes, that seems to be the name of the game.
You know, it's been such a wild ride in the last 48 hours that I would agree entirely with that statement. On Sunday night, the futures markets were rejoicing the Spanish bailout until Monday morning, when we saw that Spanish yields on the 10-year were at their highest level since the Eurozone treaty was accepted in 1999, and our markets reversed what was a 150-point gain in the Dow in the overnight and closed the session with a 150-point loss, only to wake up today and see the rally resume and get that 150 points back. So we're doing a whole lot of nothing, but we're bouncing around these key technical levels. You know, one of the few successes of policy has been to drive people into stocks because, frankly, there's nowhere else to go. You know, you're very fearful of buying treasuries because when yields are historically low, that means prices are historically high. You're certainly fearful of going out there and taking any degree of risk. So I think the U.S. market has found a comfort in the levels that we really held now for a very long period of time, and will oscillate 500 points above or below those levels, but we always seem to wind up back where we started.
Douglas, what's the expectation after the Spain aid deal, and does it seem like hopes are high that that may be the case with Italy as well, and we may see some stimulus?
Well, I think that's what the market is expecting. I'm very troubled by the notion that, you know, every country is now going to need some sort of a bailout. I mean, just to speak to the lunacy of the current situation, Italy is essentially borrowing at 6%, and again, they make up about 22% of the Spanish bailout for 3% in return. So they're borrowing at 6% against their own country to lend Spain money at 3%. You know, that was one of those numbers that just did not make any sense. And what we need to see, and we've gone over this for the last 6 months, the last year, every time we've revisited the Eurozone debt crisis, we need to see some sort of a gel that brings all of these countries together, that levels the playing field, because the minute one gets a bailout, the next two countries down the line are going to expect one as well. And you have to wonder, at some point, are we going to need to bail out the bailout? It's just that befuddling, and it does not inspire confidence, and it's going to continue until we get some sort of a a cohesive plan and a comprehensive plan to address different economies moving at different speeds, collecting different revenue and giving different entitlements to their people, all within one union.